More than $6 trillion vanished in just 60 minutes. Gold fell off a cliff. Silver didn't just drop, it collapsed. Portfolios bled red, stops were wiped, leverage was erased, and most people still have no idea why. They'll tell you it was normal volatility. They'll tell you nothing changed, but that's not true. Because this crash wasn't random. It followed a hidden signal almost nobody watches. And the last time this exact pattern appeared, it didn't end the bull market. It launched the biggest rally in decades. So here's the real question. Was this the end? Or was this the setup for something much bigger? Because before this video ends, you'll see what really caused the crash, the force moving gold and silver behind the scenes, and a specific prediction with a specific date that could turn panic into opportunity, but only if you stay to the end. Welcome to Market Metal. If you're watching this right now, you're someone who's lived through crashes, rallies, and more experts than you can count. So let me ask you, respectfully, like I'd ask someone with real-life experience, if this channel helps you see markets more clearly, would you consider subscribing? Not for hype, not for noise, but so you don't have to figure this out alone next time. And one more thing, tell me in the comments, where are you watching from today? The event that shook global capital. More than $6 trillion disappeared from global markets in less than 1 hour. This was not a slow decline, stretched over days or weeks. It was sudden, violent, and synchronized. Gold fell hundreds of dollars per ounce. Silver dropped double digits in minutes. Equity markets trembled. Digital assets followed. Across the world, screens turned red at the same time. For experienced investors, this kind of move immediately signaled danger. Markets do not destroy trillions of dollars by accident. When losses of this size appear in such a short window, it means something structural has broken, not just sentiment. It means liquidity has vanished, leverage has been forced out, and large players have moved before smaller participants even understood what was happening. Many observers were confused. Mainstream financial media described the event as volatility or a healthy correction. Analysts pointed to charts and spoke calmly, as if this were routine behavior. But those explanations did not match the scale of the damage. Volatility does not erase $6 trillion in an hour. Normal market behavior does not collapse multiple asset classes at once. Professional capital understood this immediately. They did not ask whether the move was real. They asked why it happened and what mechanism caused it. Because history shows a clear rule. When many markets fall together, the cause is almost never inside those markets themselves. The cause comes from outside, from a higher level force that controls liquidity. The collapse began during active trading hours when liquidity should have been deep. That detail matters. Crashes caused by thin overnight trading often reverse quickly. This one did not. Prices fell hard, even with buyers present. That is a sign of forced selling. Someone was required to sell, not choosing to sell. Gold, often seen as a safe asset, did not protect portfolios. Silver, which tends to move faster than gold, fell even harder. This combination was critical. When both metals decline together and at speed, it usually means the problem is not confidence in metals themselves. It means pressure is coming from the monetary system that prices them. Within minutes, margin calls spread across trading desks. Leveraged positions were closed automatically. Stop losses triggered more selling, which pushed prices lower, which triggered more forced exits. This feedback loop is known to professionals as a liquidation cascade. Once it begins, it feeds on itself. Retail investors felt the impact last. By the time many noticed the move, prices were already far below the highs. Their screens showed losses, but the real damage had already been done elsewhere. Institutional players had already repositioned. Liquidity had already been pulled. The transfer of wealth was already underway. This pattern was not new. Similar events have appeared throughout financial history. In 2008, in 2020, and in late 2025, markets experienced sharp, sudden collapses that seemed to come from nowhere. Each time, the surface explanation failed. Each time, the real cause was found in liquidity, currency pressure, or policy signals that most participants ignored. What made this event especially important was its timing. It occurred after a strong rally. Gold and silver had already posted large gains. Optimism was high. Positioning was crowded. When markets are stretched and confidence is widespread, they become fragile. Any shock can cause outsized damage. The collapse also exposed a common misunderstanding. Many investors believe gold and silver move independently based on supply and demand alone. In reality, they are deeply connected to global capital flows. When those flows reverse, metals respond immediately. The speed of the decline suggested that large institutions were prepared. They had already reduced risk or moved into defensive positions. That preparation does not happen in minutes. It happens days or weeks earlier, based on signals most people do not track. This is why professionals do not focus only on asset prices. They study the system that prices the assets. They watch liquidity, funding markets, and currency strength. They understand that price is the final output, not the first signal. For business leaders and entrepreneurs, this event carried an important lesson. Markets are not just reflections of economic health. They are mechanisms for transferring risk. When conditions shift, that transfer happens quickly and without warning. The collapse was not the end of a story. It was the beginning of a signal that something larger was moving beneath the surface, a signal that the rules of the environment had changed, even if only temporarily. The most dangerous response to such an event is confusion. When participants do not understand why losses occurred, they are likely to repeat the same mistakes. They react emotionally. They sell at the wrong time or double down without a plan. Understanding comes before strategy. Before deciding what to buy, sell, or hold, decision makers must understand what caused the shock in the first place. Without that clarity, every move becomes guesswork. This event was not random. It followed a recognizable structure. It left clear fingerprints. And those fingerprints point to a force that most investors rarely watch, but that quietly governs gold, silver, and global capital itself. To understand what truly collapsed gold and silver, one must look beyond the metals and toward the system that measures value across the entire world. The hidden mechanism. Most investors never watch. What collapsed gold and silver was not fear. It was not panic. And it was not a sudden loss of belief in hard assets. The real cause sat above the metals market, quietly shaping every move long before prices broke down. Professional investors knew this. Most others did not even know where to look. The force behind the collapse had a name, but it rarely appeared in headlines. It was not gold. It was not silver. It was the US dollar itself. In global markets, gold and silver are not priced in isolation. They are priced in dollars. That single fact explains more crashes than most technical indicators combined. When the dollar strengthens rapidly, everything priced in dollars comes under pressure. Not eventually, immediately. Professional traders understand this relationship clearly. They do not start by watching gold charts. They start by watching the currency system that defines global pricing. At the center of that system is the US dollar index, commonly known as the DXY. The DXY measures the dollar's strength against a basket of major currencies. When it rises, it signals that capital is flowing into the dollar. When it rises sharply, it signals urgency. Capital is not moving calmly. It is moving defensively. On the day gold and silver collapsed, the DXY surged. It did not drift higher. It jumped. That jump changed the entire environment in minutes. For gold and silver, this was not a warning. It was an order. There is a structural relationship at work. When the dollar strengthens, fewer dollars are needed to buy the same ounce of gold. The price must adjust downward. This is not opinion. It is arithmetic. And when that adjustment happens quickly, leveraged positions cannot survive. Silver reacts even faster. It is smaller, thinner, and more volatile. When the dollar spikes, silver does not ease lower. It drops hard. This is why silver often feels brutal during corrections. It is not malfunctioning. It is responding exactly as the system demands. Most retail investors never see this coming. They are focused on metal-specific news, mining supply, inflation stories, long-term fundamentals. Those matter over time, but they do not stop short-term liquidation. Liquidity always wins in the short run. Institutional capital knows this. Hedge funds, banks, and large asset managers track currency pressure constantly. They see dollar strength before it hits the news. They adjust exposure quietly. By the time metals fall on retail screens, institutional repositioning is already complete. This is where the collapse becomes dangerous. Leverage enters the picture. Gold and silver markets contain enormous leveraged positions. Futures, options, margin accounts. These positions are stable only as long as price moves slowly. When price moves fast, leverage becomes a weapon against its owner. As the dollar surged, gold prices slipped. That slip triggered margin calls. Margin calls forced selling. Forced selling pushed prices lower. Lower prices triggered more margin calls. The cycle fed on itself. This is why the collapse felt sudden and uncontrollable. It was not driven by opinion. It was driven by rules. Automatic rules inside trading systems that liquidate positions without emotion. Stop losses did not protect traders. In fast markets, stops often trigger at worse prices than expected. Some were skipped entirely. This is not manipulation. It is a liquidity gap. When too many want out at once, exits disappear. The most important detail is timing. The dollar move came first. The metals move followed. This order matters. It proves causation, not coincidence. Yet most commentary ignored this. Analysts debated sentiment. Others blamed profit-taking. Some even blamed mysterious forces. Very few explained the currency mechanism clearly. That omission is costly. When investors do not understand the real driver, they repeat the same mistake. They buy metals while ignoring the dollar. They hold leverage while currency pressure builds. Then they are surprised by losses that were visible in advance to those watching the right indicator. This collapse exposed a gap in market education. Many participants believed gold and silver exist outside the monetary system. In reality, they sit at its center. They react to policy signals, currency flows, and global liquidity faster than most assets. Professional capital treats gold and silver as currency instruments first and commodities second. This is why professionals survive crashes that destroy retail portfolios. They are not smarter. They are watching the correct battlefield. For business leaders and entrepreneurs, this distinction matters deeply. Markets reward understanding, not conviction. Belief in an asset does not protect capital if timing is wrong and structure is ignored. The dollar surge did not happen by accident. It was responding to pressure elsewhere in the system, pressure created by policy signals, global uncertainty, and capital-seeking safety. To understand why the dollar surged at that exact moment, one must step back further, beyond metals, beyond currencies, into the forces shaping global capital decisions. Because the dollar did not rise alone. It rose because three powerful forces aligned at the same time, and when those forces converged, collapse became unavoidable. That convergence is the real story behind the crash. When three pressures converged, the dollar did not surge in isolation. Currency strength at this scale never comes from a single cause. It emerges when multiple pressures align at the same moment, reinforcing each other. On the day gold and silver collapsed, three separate forces converged. Each one alone would have created stress. Together, they created a shock. The first pressure came from monetary policy. For months, global markets had been positioned for easing. Investors expected lower interest rates and a softer dollar. That expectation had become consensus. When consensus builds, risk builds with it. Then the tone changed. Signals from the Federal Reserve shifted from accommodation to caution. Policymakers began emphasizing inflation risks instead of growth risks. Language hardened. Rate cuts were delayed. The message was clear. Interest rates would remain higher for longer. This matters because capital follows yield. Higher rates make dollar-denominated assets more attractive. Global investors do not debate this. They respond to it. When yields rise, money moves toward the dollar automatically. The moment markets realized rates would not fall as expected, positioning became wrong. Traders who had bet against the dollar were suddenly exposed. They had to reverse those bets quickly. That reversal created upward pressure on the dollar and downward pressure on everything priced in it. The second pressure came from China. Unlike gold, silver is not only a monetary asset, it is also an industrial input. More than half of global silver demand comes from manufacturing. Electronics, solar panels, electric vehicles, and data infrastructure all depend on silver. Much of that production flows through China. When new data showed Chinese manufacturing slowing, concern spread quickly. Factory output weakened, export demand softened, growth momentum slowed. For silver, this mattered immediately. Traders began reassessing industrial demand. If factories slow, fewer components are produced. If fewer components are produced, less silver is consumed. This logic does not require confirmation. Markets price expectations, not outcomes. As concern grew, silver faced a double burden. It was already under pressure from a stronger dollar. Now it was also under pressure from demand uncertainty. That combination explains why silver fell harder than gold. This is a critical distinction. Silver does not just follow gold, it amplifies gold. When conditions are favorable, silver outperforms. When conditions turn hostile, silver suffers more. The third pressure came from political risk. Markets dislike uncertainty, especially when it threatens liquidity. As the deadline for a U.S. government funding agreement approached, the risk of a shutdown increased. Shutdowns do not always cause economic damage, but they disrupt confidence. For large investors, confidence is not emotional. It is operational. Political instability complicates forecasting. When forecasting becomes unreliable, risk must be reduced. At the same time, many investors were sitting on large profits. Gold and silver had already posted significant gains. A rally of that size attracts short-term capital. Short-term capital exits quickly when uncertainty rises. The shutdown risk provided an excuse to reduce exposure. It did not need to be the sole reason, it only needed to exist. Once selling began, it fed on itself through leverage and forced liquidation. This is how complex systems fail, not through one dramatic cause, but through multiple stresses that align. Each stress weakens the structure. When the final one arrives, collapse follows. The order of events matters. Policy pressure strengthened the dollar. Economic data weakened industrial expectations. Political risk encouraged profit-taking. Together, they pushed capital into safety and out of risk. That safety was the dollar. As the dollar absorbed capital, everything else adjusted downward. Gold fell, silver fell harder. Leveraged positions were erased. The cascade accelerated. This alignment explains why the collapse felt sudden but was not random. The conditions had been forming quietly. Only the final trigger was visible. Professional investors recognized this pattern. They did not debate whether the sell-off was justified. They focused on whether it was complete. History shows that when multiple pressures align, markets overshoot. Forced selling does not stop at fair value. It stops when sellers are exhausted. The critical question is not why prices fell. That is now clear. The question is, what happens after forced liquidation ends? This is where most investors fail. They assume crashes signal endings. In reality, crashes inside larger trends often signal transitions. To understand what comes next, one must examine historical precedent. Specifically, what has happened in similar moments when sharp collapses followed strong rallies, because this was not the first time gold and silver experienced a violent correction under these conditions. And the outcome of the last occurrence holds important clues. The past does not repeat perfectly, but it does reveal patterns. And the pattern that follows this type of collapse may surprise those focused only on today's losses. Understanding that pattern is essential for anyone making long-term capital decisions. After the collapse, the transfer. Few recognize. When forced selling ends, markets do not announce it. There is no signal, no bell, no headline. The exhaustion of sellers happens quietly beneath the surface, while fear is still loud. This is the moment most participants miss, because emotion is strongest when opportunity begins to form. History shows a clear pattern. Inside broad bull cycles, sharp collapses are not conclusions. They are stress tests, they remove leverage, punish poor positioning, and reset expectations. What remains afterward is a cleaner market, one controlled by capital that can hold through volatility. This is why experienced investors do not ask whether a crash is painful. They ask whether it changed the structure. In this case, the structure remained intact. Gold and silver did not fall because their long-term role disappeared. They fell because liquidity shifted temporarily. The forces that drove demand over the previous months did not vanish in 60 minutes. Central banks did not stop accumulating reserves. Sovereign buyers did not reverse strategy. Industrial demand did not evaporate overnight. Mining supply did not suddenly expand. None of the foundational drivers changed. What changed was sentiment. Sentiment is fragile. It can flip faster than fundamentals. When fear replaces confidence, prices overshoot in both directions. This is not weakness in the system. It is how the system transfers risk from those who cannot hold to those who can. After liquidation cascades, markets often enter a deceptive phase. Prices stabilize, volatility slows, commentary quiets. Many assume danger is past or that interest has died. In reality, this is when professional accumulation begins. Large capital does not buy during panic spikes. It waits for silence. It waits until sellers are gone and price stops falling despite bad news. That behavior signals exhaustion. This phase matters more than the crash itself. It determines who participates in the next move. There are always three possible paths forward. The first is continuation. The collapse proves temporary. Liquidity returns. Prices recover faster than expected. Those who sold in fear watch from the sidelines. The second path is deeper correction. The pressures that cause the collapse intensify. Prices fall further. Confidence weakens more. This outcome requires reinforcement from policy or economic deterioration. The third path is consolidation. Markets move sideways. Volatility frustrates participants. Attention fades. This path often precedes the strongest rallies because it removes speculation quietly. The mistake many make is assuming the worst outcome by default. That assumption feels safe, but it often leads to inaction at the wrong moment. Professional capital does not rely on feelings. It watches indicators. It watches currency pressure, policy signals, and liquidity conditions. When those pressures ease, risk returns quickly. The dollar, which caused the collapse, is also the key to the recovery. If dollar strength stabilizes or reverses, metals regain support. This relationship works in both directions. For business leaders and entrepreneurs, the lesson is not about trading metals. It is about understanding cycles of stress and recovery. Capital environments tighten and loosen repeatedly. Those who survive are not the smartest. They are the most prepared. Preparation means knowing the difference between volatility and structural damage. Volatility is movement. Structural damage is impairment. This collapse showed movement, not impairment. Another lesson lies in leverage. Leverage magnifies outcomes, but it also removes control. In fast markets, leverage turns small errors into permanent losses. Those who were forced out did not lose because they were wrong about the long-term direction. They lost because they could not survive the short-term pressure. Those who held unleveraged positions still own the same assets they did before the crash. Their exposure did not change, only the screen price did. This distinction separates speculation from strategy. Strategy survives volatility. Speculation does not. There is also a broader implication. Events like this reveal how quickly capital can move when incentives change. They remind decision makers that liquidity is not guaranteed. It appears abundant until it is suddenly scarce. In business, this applies beyond markets. Companies that rely on continuous funding, tight margins, or optimistic assumptions are vulnerable when conditions shift. Those with reserves, flexibility, and planning endure. The collapse was a warning, not just for investors, but for anyone exposed to global capital flows. It showed how fast conditions can reverse and how unforgiving systems become when expectations break. What happens next will not be decided by headlines or opinions. It will be decided by policy direction, currency behavior, and the willingness of capital to re-enter risk. Those watching the right indicators will see the shift before it becomes obvious. Those watching only price will react after it happens. This is how wealth transfers quietly, not through intelligence, but through positioning, not through prediction, but through preparation. Markets do not reward hope. They reward understanding. The collapse removed trillions from one side of the ledger and placed them on another. That transfer is now complete. The next phase belongs to those who recognize what just happened and what did not. Volatility exposed weakness. What follows will reward patience. The question is not whether markets will move again. They always do. The question is whether decision makers will be ready when they do. Because moments like this are not rare. They are simply misunderstood. And misunderstanding is always expensive.